Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Getting Started with Options. And over the last 8 weeks, we've been building up through a series of lessons to bring along that brand new would-be trader of options, from knowing nothing about trading option strategies to being able to build fairly complicated combination strategies. This is lesson 9 in our series of 10, and today we're discussing building a combination strategy known as a short put spread, also known as a short put vertical. It's a bullish strategy we can add to our potential list of toolbox strategy candidates. I'm really looking forward to today's discussion. Before we can get to that, though, let me first of all say hello to everybody out there. Great to see you all on YouTube. Hello, Ranjit and Stacy, David, Robert, Jay Richardson, Greg, Life in the Fast Lane, John, Ted, Jack, everybody else. Thanks for joining us week after week. We really hope you've enjoyed those first 8 lessons. We really appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. I'll invite you to just stick around, watch the whole lesson, even if you haven't seen the first 8, but I'll also show you where you can find those first 8 if you want to get caught up. And I also want to say, if you're watching the YouTube archive after the fact, if you're just enjoying the recording of this presentation, enjoy that webcast, but also be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series, kicks off promptly noon Eastern. We'd love to have you here in the live stream audience. And as for our live stream audience, I also want to give them the heads up that my very good friend Connie Hill is hanging out in the chats. She's going to be addressing any questions that I can't get to. Connie knows all about this stuff. Connie and I have now been working together for about 20 years. So we know that she brings a lot of knowledge to this discussion. Thanks for having my back there, Connie. And Connie and I would also like to issue an invitation to everybody watching. If you have an account with X, give us a follow. Follow your favorite presenters on X. You can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. And that really is the very best place to connect with your favorite presenters in between the live streams. But let's get right into this lesson 9. And as we kick things off, of course, we need to first of all consider the risks associated with investing and trading. Certainly applies to options trading, so bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so if you didn't see the first 8 lessons, here's where we've been. We've gone through the first 8 lessons. First 4 were dedicated to learning the basic building blocks upon which all option strategies are built or constructed. So building blocks 1 through 4, long calls, long puts, short calls, short puts. Then we went through the options pricing and Greeks. Then we started getting into building combination strategies in lessons 6, 7, and 8. That brings us to lesson 9, a bullish strategy known as a short put spread, also known as a short put vertical or short put vertical spread. We have multiple names for the same strategy. But we're going to be talking about that strategy today, combining really 2 put options. So here's the agenda to get that accomplished. We're going to talk about the what's and the whys of short put verticals. What are they? Why do some traders turn to them at times when they think the markets or stocks might be bullish? We'll discuss the basic construction, the basic elements of short put verticals, talk about when a trader might choose to enter them, when they might choose to manage the trade or exit. And of course, we're going to place at least one example trade before we're done today. So really, let's get right into this. Really looking forward to it. Let's go right to the Thinkorswim desktop platform. And I just wanted to start off with an example. This is going to be the one that we're building our example short put spread on. We're using Medtronic. Now, before we launch into the discussion of the strategy, let's talk about or just revisit the sorts of characteristics in a stock that a trader might consider for qualifying a stock as a potential candidate for doing a short put spread. So as we've discussed over and over again, this is like our 8th strategy that we've learned in this lesson series. Well, for each of our option strategies, there are some elements that a trader might consider. Number one is the kind of company behind the stock. So for bullish strategies, and this is a bullish strategy, maybe the trader is looking for companies that appear to be healthy from a financial perspective. Maybe their earnings are growing, maybe their revenues are growing, maybe their outlook for the future is strong as far as profits and sales are concerned. However the trader wants to qualify that fundamental health, some traders take that in consideration. Not everybody does, though. But another consideration potentially is the price per share and the liquidity of the stock. High-priced stocks can offer more options. That can be nice for building the strategy, but also those higher-priced stocks carry larger potential obligations, especially when we're doing these short option strategies. Illiquid stocks tend to have illiquid options, low-volume stocks. If the stock isn't trading heavily, its options almost always are not trading heavily either, and that can lead to pricing issues for the would-be trader. So for some, a real point of emphasis is millions and millions of shares being traded on the stock. So hopefully the options are as liquid as they could be, right? So those are some considerations. How healthy is the company? What's the price per share? How's the liquidity? But also for some, they look at the chart. So let's talk about the chart of Medtronic here for just a moment. And this is a bullish strategy, so maybe, hopefully, the trader is seeing something bullish. Now, you might look at Medtronic and say, Cameron, it's down 1% today. Yes. But what's been going on recently that might catch the attention of a bullish stock chartist? Well, just yesterday, Medtronic had its strong day that actually took it up into territory that traders have not seen on this stock, actually, not just in weeks or in months, but in years. There was an apparent price ceiling about here to around 92.5. You can see that over the last 5 months, stocks tried to get above that level on a number of occasions. But actually, if we stretch this chart out, let's look at a 3-year chart. You can see that's actually been the case going all the way back to where we spent just a few weeks above 92.5 all the way back in 2022. So we may be seeing what we might call a breakout just from yesterday. So let's say that our trader is thinking, oh, we just cleared an apparently important price barrier, and maybe the stock is going up from here, at least for a while. So let's turn our attention to this time frame, March 21st. We're going to be planning an example trade today for March 21st on the assumption that maybe our trader thinks that the stock is at least going to stay above that 92.5 barrier that it just broke. So how might a trader benefit potentially from that? Well, first thing they might do is if they really think the stock is likely to be bullish, could buy a call. As we discussed in lesson 1, buying a call is a bullish strategy. Or maybe they sell a put. To start off our example trade today, let's say that our trader is considering selling a put at that 92 level, right? About there. And let's do that for the March 21st expiration. In this case, they'd be entering into a contract through March 21st, where they're accepting a payment from another trader out there in the trading universe. And in exchange for that payment, they have an obligation where the other trader has the right to sell shares to our hypothetical trader for $92 per share. Now, as long as the stock is above 92, it's unlikely that they'll ever be required to buy the $92. And if we're still above 92 by March 21st, the highly probable outcome in that scenario is the contract just expires worthless, unassigned, and the trader keeps the money that was paid for that $92 obligation. So let's go have a look at this. Let's go to the Trade tab, and we're going to start to build our example trade. Because this example trade does begin with, conceptually, a short put, selling a put. So this is called a short put spread. So as the first leg of the first side of this trade, let's look at maybe that $92 put for the 21st of March. Now, I kind of cheated. I went to the Trade tab. I already had the 21st of March open. So let me close that up again so you can see how I found this. Trade tab, make sure that we have the right symbol, and then we'll click on the 21st of March. And as we go down the list of available strikes, let's maybe look to strike a deal to possibly exchange shares of Medtronic at $92 per share. Looks like that's trading between 114 and 122. If we split the difference, maybe our trader here can sell this put, sell the 21st of March, $92 put. Maybe we can get $1.18 for that. So just to revisit this trade, if we just did this all by itself would be a bullish strategy. We discussed this strategy explicitly in lesson 4 in this series. So if you need to go back and catch up on that, go to lesson 4. Matter of fact, let me hit the pause button here. I'll show you where that lesson 4 is found. If you want to find these lessons, first of all, make sure you're subscribed to our YouTube channel. You can go down and click on the subscribe button below the video right now. If you haven't done that already, just click on subscribe. But our YouTube channel called Trader Talks Schwab Coaching Webcasts is where we house previous webcasts. And you can find those here under our playlist. Now you can also join live streams there, but I'm going to go to the playlists and I'm going to scroll down almost all the way to the bottom. And actually, you might be thinking you're looking for my face because I teach this webcast series. Actually, previously, last year, Barb was teaching this webcast series, so you're going to see Barb's face here. But right there, it says Getting Started with Options. If I click on View the Full Playlist, though, you can see there are the other 8 lessons. All right, so in lesson 4, we talked about short puts. So if you want to go back and learn just the basic elements of this side of the strategy, you can do that. But let's go back to Thinkorswim and talk through this obligation again. What is this contract we're conceptually entering into here? Well, if we're able to sell this put for 118, that is, we're collecting a premium of $1.18 per share. Somebody conceivably here paying us $1.18 per share for the right to sell us 100 shares of stock. So at $1.18 per share, that's $118 that we're getting paid. But in exchange, through the 21st of March, the other party in this transaction has the right to sell shares or put shares to us for $92. So we now know for the next for the next 17 days through the 21st of March, we might have to cough up $92 per share. Now, there is a risk in that. Let's say we just did that. I'm going to click on this on the bid price to create a sell order for just the short put. So there we are. We're going to sell one of these contracts just as an example, the $92 put. Maybe we get $1.18. It looks like that price is falling a little bit. Let's just leave it there. That's okay. I'm just going to click confirm and send. But what I want to point out here is the amount of profit. You know what? Just so we keep the numbers consistent. I said $1.18. Let's say we're going to require 118. May not fill for that price. That's okay. But just so that we can see the actual numbers here, if we're able to sell this for 118, there's $118 on the table for us. We might make a maximum profit of $118. Now, here's where some traders pump the brakes. Whoa! What's the loss potential on this trade? $9,082. Ouch. Yeah, big downside risk on this trade. That's because we know for the next 17 days, we might have to buy shares for $92 per share. We have no idea at that point, now that we're the proud owners of the shares, how much we'd be able to sell those shares for. All we know is how much we might have to buy them for. So if the stock has collapsed in value, the further down it goes, the more this stings to have to buy the shares at $92. If we have to then maybe have to sell them at 90 or 85 or 80 or 75, the further the stock goes, the bigger the risk here. And that stock can go all the way to zero. And if we lose $9,200 on the stock, and we only have $118 in consolation prize from the premium that we collected, that's a $9,082 risk. That's where that risk comes from. Plus, throw on a little commission here. So for some traders, they get the concept here, and they also might say to themselves, yeah, but what are the odds that Medtronic literally goes to zero in the next 17 days? Doesn't sound likely. It's not likely. Still within the realm of possibility. But the inherent risks of this, number one, there's a huge dollar risk. So we have to be aware of that. We have no defined price at which we can sell the shares if we get stuck with those shares at $92. And therefore, there's a large cash requirement when selling a cash secured put. We'd have to have the $90,000 or $9,068. What was it? 9,000. I'm going to have to click confirm and send again. 9,082. It's just 9,200 minus our 118. Anyway, yeah, we'd have to have that much tied up in cash, especially if we're directing this into an IRA or a cash account. So, how do we address those issues that some traders might take issue with? Well, at the same time, we sell a short put, we're also going to buy a long put. We're going to buy, in this case, let's just delete this. Come down here, go back to our option chain, and let's buy another put that's less expensive than our put that we sold. So in this case, how about we do, just for nice round numbers, let's just go $2. How about we go to the 92? Let's buy the March, buy the 90 put. Let's buy the March 90 put. How much is that trading for? That looks like that's trading between 62 and 70 cents. Split the difference. Let's call it 66 cents. So what does this add to the equation? Because there's a cost associated with this. We're taking some of the $118 that we just collected, and we're going to spend it. We're going to spend that on. We're going to spend 66 cents of that. But here's what that does for us. We know when we sold the $92 put, we have the obligation potentially to have to buy shares at $92. And we had this kind of scary scenario where we didn't know how much we could sell the shares for. Well, if we own a put that has the same number of days on the same underlying stock, we now have a defined, contractually guaranteed ability to sell the shares at a specified price. So for the next 17 days, if we get, I'm going to use the phrase, if we get stuck with the shares, because actually getting those shares is not the design of this trade. It's not the preferred outcome of this trade. But if we get stuck with the shares at 92, at least we now know, even if they fall down to 10 bucks a share, we can sell those shares for $90. We've just dramatically whacked that risk, that downside risk. It was over $9,000 of risk, and for the cost of 66 cents per share, or $66, we reduced that $9,000 risk to $2 per share. If we have to buy shares at 92, sell shares at 90, that would be a $2 risk. Let's do some math here. What is the theoretical max loss of this trade? If we get assigned and have to buy the shares at 92, but we can also exercise our contract, sell those same shares that we don't want for $90, that'd be a $2 loss. But it's not even a $2 loss because we collected a credit to set this trade up, and that would still be in the portfolio in this outcome. So what's our difference there? That looks like about 52 cents. Call me out if I'm wrong. I do the math in my head sometimes. I blow it. So let me know if I did this wrong. But we have a net credit of 52 cents. Again, here's the math. 118 collected minus 66 cents spent, 52 cents. So if we apply that against our $2 loss on our stock, that would leave us with $1.48 that could be lost on this trade. And that becomes the maximum theoretical risk. So instead of being over $90 per share of risk, we spent 66 cents to limit that risk to just $1.48. And so for some traders, they consider this a very much worth the investment. That's just an accepted cost of doing these sorts of trades. Doesn't mean everybody's going to choose to do it this way. But in this example, this is going to be our short put spread. So why do we call it a short put spread? Well, short is a term that we use in trading whenever we sell something to initiate a trade. So in this case, we're selling a put to get into a trade. So we're short that put. We're also constructing the trade using puts, and there is a spread between the two prices. There's a $2 difference or a spread. 92 up here, $90 down there, a $2 spread. And as we discussed in lessons 6, 7, and 8, that spread is vertically oriented. 92 is vertical, it's above 90, so this is a short put vertical spread. That's where the terminology comes from, at least the way that I think about it. So this is our maximum theoretical loss on our trade. How much can we make on this trade? Well, if we collected $1.18, spent 66, that leaves us with that credit of 52 cents. That's actually the most we could make on this trade. Our theoretical max gain is the 118 minus the 66 cents spent. That's 52 cents. Now, anytime I'm talking in cents or pennies or, it just doesn't sound like a lot, but actually, this is a considerably high potential rate of return on the amount of money that we have tied up in this trade. Because in our portfolio, if I built this trade just like this, let's go ahead and do this. So if you want to see how to enter the trade, and I don't typically do the trade this early in a webcast, but we've been through a few other similar strategies already. I'm going to go ahead and place this trade. So here's a quick way to enter the order on Thinkorswim. We can go to the option that we're considering selling. In this case, that's the 92. And we click on the bid price. And that creates a sell order. Now we can go back up to the option chain. Let me just minimize this is not going to delete the order. It's just going to hide it down at the bottom of the screen. If I click on this little down arrow, that just minimizes it. Go back to the option chain. I'm going to hold down the control key on my keyboard and then click on the ask price for the option that I intend to buy. So that's the $90. So I'm going to click on that ask price, and that creates our vertical spread, right? Now, looks like that might be 51 cents. I'm going to do this. Let's say, I'm going to do a little bit of rounding. Let's say, and who knows where the actual numbers actually pan out if the order fills. Let's say that we're able to sell the 92 for $1.20, but we have to spend 70 cents on the 90. Whatever, but in any case, let's say that the difference turns out to be 50 cents instead of 52, so we only get to keep a 50-cent credit. And so our risk-reward scenario changes a little bit. I'm just going to use nice round numbers. I think it just makes everything easier for those trying to follow along. So if we have $2 that we could lose, but 50 cents has been collected, that leaves us with a $1.50 risk. And if we collect $1.20 and spend 70 cents, that leaves us with a net credit of 50 cents, right? But in any case, I did all of that so that I can do this. Let's just assume a credit of 50 cents. Well, if we're left with $1.50 per share, or on one pairing of contracts into a vertical spread, $1.50 times 100 shares, that's $150 of potential risk. Now the trader can start to build that assumption into how many contracts they get themselves into. So if we could lose 150 bucks on one vertical spread, what if we did 10 vertical spreads? That would be a $1,500 risk. Actually, for this one, I'm going to do exactly that. Let's dial this up to 10. All right. But let's click confirm and send. We're going to enter this as a limit order, selling 10 of these 92, 90 put spreads, trying to get at least 50 cents. When we put in a limit order, that means, hey, that's the least I'm willing to accept. That's my limit. I'm not going to accept 49 cents and 48 cents. If we're able to fill for that, that would give us a maximum profit. It's a funny way to put it, but depends on where we fill. Let's say we fill at 50 cents. That would give us a maximum profit of $500 on 10 contracts. That would give us a maximum loss of $1,500 on 10 contracts. Multiple contracts mean multiple commissions, so there would be a $13 net commission here. So bringing our credit, if we're able to fill, for 500 bucks, it brings it down to 487. But let's send this off. Let's see if we can get this filled. Let me go to my monitor tab. When we place a trade, we can go to the monitor tab. Oh, look at that. We sold it for 50 cents. Nice. So all of this lines up beautifully. So what have we just gotten ourselves into? We are now into we're into two different contracts. We may have to buy 1,000 shares of stock at 92 bucks per share, but we know if we need to, we can sell that same 1,000 shares of stock for 90 bucks. Worst case scenario. So let's play those scenarios out on our chart here. So we already have a line drawn in at 92 to represent this option that we're selling. Let's draw in another line at $90. As a matter of fact, let me move this one over just a little bit. I'm going to position it under today's candle. That just indicates to me, it's just a visual reference point to tell me that that's when I started the trade. You don't have to do this. This is really just more of a teaching thing than anything else. Okay, but let me draw in another line at the $90 level as closely as I can. So those represent our two strikes. Now this is a bullish strategy. Just remember, this is a bullish strategy. The trader here prefers for the stock to go up, or for it to at least not go down too much. Because if we're above 92, let's walk through what could happen with this trade from here through the next 17 days. If we're above 92, we're at 93 or 94, let's just say 95. And someone has the right to sell shares to us for $92, do they have much motivation to do that? Shares are worth 95. Are they going to say, Cameron, I could sell my shares on the open market for 95, but I'm going to sell it to you for 92 just because I can. No, it doesn't make any mathematical sense. Now, every once in a while, somebody gets a wild hair and does exactly that, but it's not likely. All right. So they're going to say, forget it. They've run out of time. The shares are worth more than what they can sell them to me for, or to our trader here for. So they walk away from the deal and they're done. So we keep the $1.20. Awesome. But at the same time, we spent 70 cents for the right to sell shares to somebody else for 90 bucks. Well, 90 is all the way down here. Do we, or does our trader here have motivation to sell shares that are worth 95 to someone else all the way down at 90? No. That is now a sunk cost. It expires worthless. So in that case, we lose the 70 cents. We keep and realize the gain on the $1.20. There's no further obligation there. And that results in our 50-cent maximum gain. $50 now realized. On 5 contracts, that's a on 10 contracts, that would be our $500 profit. So really, anywhere up here is where we'd like to be. Yes, for the next 17 days, but also especially as we hit that March 21st threshold. So even if we came down for a while, but then went back up, as long as the short contract was not assigned before then, we could still be in position for maximum gain. So this is a bullish strategy. We want this as the outcome. Well, what if the opposite happens? What if this stock that's been going up so rapidly, even though it cleared that apparent important price hurdle, what if it decides to go right back down again? I don't want to draw it. Let me remove this drawing. Switch this over here. Let's say our share value collapses down here to 88 bucks. Steep sell-off. Could it happen? Yep, it could happen. If the shares are worth 88 and someone has the right to sell shares to us for 92, are they going to do it? Yes, with very rare exceptions. They say, Cameron, hey, my shares are only worth 88, but my contract says I can sell them to you for 92, so they sell us those shares. Crud. Stuck with shares at 92, what are we going to do with them? Sell them to somebody else for 90. We didn't want to do that. That's a $2 loss, but that's better than being stuck with shares at 88. So that's a $2 loss, for which we originally collected a 50-cent credit. We still have the 50 cents. So that leaves us with the $1.50 loss if we fall down here. So down here becomes our maximum loss territory. This is not where we want to go. Okay, so let's make that red. Well, there's one other place we could wind up. We could wind up above 92, we can wind up below 90, or we can wind up in between. Oh, and look at me drawing another rectangle. I don't need a rectangle. Let me remove that drawing, switch back here to my trend line tool. And let's suppose instead price falls, and it winds up somewhere in between our strikes. This is where things get particularly sticky. Got to be aware of this, because this is a possible outcome. It's not a probable outcome. It's only a small possibility. But it is a possibility. What if our stock falls down here to, let's say, $91? Well, that means we're below our maximum gain scenario. We're above our maximum loss scenario, so somewhere in the middle. Well, if we're at $91 and someone has the right to sell shares to us for 92, are they going to do it? Yeah, they're going to do it. They have the right to sell shares for us to us for 92. Can't get that price anywhere else. So they do it. They assign the contract. We wind up buying the shares. We now own 1,000 shares of Medtronic. Okay? What are we going to do with those 1,000 shares? You might think, oh, let's just dump them. Let's exercise our contract to sell those at 90 bucks. We don't want to do that. Our trader does not want to do that. If the shares are worth 91, even though our contract says we can sell them for 90, we don't want to. That would be, if we sell them for 90, that would be selling at a $1 discount on 1,000 shares. That'd be a $1,000 mathematical error. Instead, what might we do? Just sell the shares on the open market. Our contract turns out we don't do anything with this. So in that case, how did we do? Well, we bought the shares for 92. We sold them for 91. That's $1,000. It's a $1 loss per share on 1,000 shares. Sounds like a huge, scary deal to wind up with 1,000 shares of stock. What it actually turns out to be is a $1,000 loss on the stock, but we did get the 50-cent credit on the options. Those options contracts are now done, so we have the 50-cent gain on the option. So really, overall, we lost 50 cents in that scenario. With this trade, a quick way to calculate like the break-even point on vertical spreads is to figure out where we need to be. In this case, we need to be above $92 for maximum theoretical gain. And then just subtract how much we can make on the trade from that area. So in this case, it's a bullish spread. We'd like to be above 92 to make our maximum gain. That means if we're below 92 to some extent, we must not be making maximum gain. For every penny that we're below 92 at expiration, we're coming up a penny short of our maximum gain. So if we are 50 cents below 92 at expiration, that's our break-even point. If this were a bearish trade, and we've talked about a couple of bearish strategies, let's say it had a 50-cent potential maximum gain, it would be 50 cents above the low strike where we need to be in our position for maximum gain. That's it. Let me see what questions have come in. Mark says, sell the shares directly, don't exercise a lower price put. Yeah, Mark, you know, I think it just makes sense when we first learn about these strategies. We know, okay, it's a covered position. We have the right to sell our shares for 90 bucks. Just because we have the right, though, doesn't mean that we always want to do that. That's sort of that's sort of the worst case scenario emergency outlet for this trade, to stem the bleeding. What we don't want to do is add to the bleeding by exercising our right here. Kurt says, what about early assignment? The stock price could rise. That's exactly right, Kurt. What if all this happened not at expiration? What if we dropped down to $91 and somebody decided, you know what, I'm not waiting until expiration. I'm selling these shares to Cameron for 92 right now. Shares are worth 91. We still have the right to sell at 90 if we need to, but still some time. So in that case, maybe the trader just, well, there are a number of things they could do. They could just say, I didn't want to be in this situation. Let me sell the shares. Let me sell my put for what I can get for it and just be done. Or they might wait to see, like Kurt is proposing, if the stock goes up and we own 1,000 shares, maybe we'll wait it out. Just be aware that is a $92,000 investment that we're holding on to for a while. But let's talk about, we've talked about how this trade can pan out. Let's hit on a couple of things. When might these trades be taken? When might they be exited? We've actually started hinting at exits. But what are some potential entry signals for these? Well, we've talked about one, a breakout where we have a price ceiling and we push up through that. To some technical traders, that might mean the stock is about to go for a nice run, and that can be an entry. But alternately, maybe a trader isn't looking for something that's been going up to generate a signal, but actually something that's been going down to generate a signal, in the spirit of maybe entering low and exiting high. Buy low, sell high, they say. So let's look at an example like, how about Amgen? Amgen is a stock, it's kind of, for those that are watching this later, today's a rough day on the markets, and yet there are still some stocks that are doing okay. With Amgen, it's been running up and pulling back and running up and pulling back. And for some traders, they look for this sort of a thing where prices run down and then start to bounce higher. We've talked about bounces before, but when stocks pull back, some traders will look to that as a potential entry. And specifically for some, they'll look to see which day got the lowest. And in this case, this was our lowest day. And then if prices can just rally above that lowest day, closing above the high point of that low day, that might be their entry. That might mean that in the short term, the momentum has returned to the bullishness of the stock. And you can see that despite today's red candle, we're trading above the high of that low day. That may be an entry known as a bounce or a hold entry. Close above the high of the low day, hold. All right, so that's another reason for some they may take a bullish strategy approach like a bull put spread. Now, there are literally hundreds of other potential entries using technical indicators, using candlesticks. That's going to be up to the individual trader, but I wanted to give a couple of examples for this discussion. So for entry, there are a couple of examples. What about managing the exits? Well, there are a few potential exits. Some management techniques for when a trade is going well, other management techniques for when a trade is not going so well. So let's go back to our MDT position. We actually have this trade going on right now. Let's assume the stock does what we hope it does, and it just keeps going higher. Well, in that case, trader might just hold on and let these contracts just expire worthless and realize the maximum gain that way. Keep the credit. If the stock is going up here, the assignment risk is lower, we just wait for expiration. Now, as we discussed with our short call spread, well, maybe the trader doesn't need the full gain. Maybe if they can get out just with most of that gain, they'd be happy. So how about for this one? We've already collected a 50-cent credit. What if we were able to buy out of this contract and just be done for 10 cents? Well, that would leave us with a 40-cent realized gain. That's 80% of the 50 cents that we collected. How about we do that? Let's go back to our position. Here's our MDT position right down here. Let's see how much we filled these. Look at this. They're trading at exactly the mark that I put up. That's kind of funny. Anyway, I'm going to right-click on this existing position. This is how we can enter a closing transaction after we're already in a trade. We go to the Monitor tab, right-click on our symbol, and create a closing order for those verticals. Buying 10 verticals. Now, notice to buy out right now, it's pretty much what I sold those for. I don't want to sell to get into the trade for 50 cents and then buy to get out of the trade for 50 cents. Let's say we want to do this for 10 cents. There we go. And let's make that a good till canceled order. So what we're telling the system now is, hey, any time between now and the 21st of March, if I can buy out of this deal for 10 cents, get me out. Maybe it's tomorrow. That's not likely, but it's possible. Maybe it's a couple of days before expiration, but at any point, if I can get out inexpensively, in this case, 20% of the original premium collected is being spent, let's click confirm and send. Now, not everybody is going to set it at like 20% of the original premium. It might be 50 cents. Who knows? Or 50%. But let's place this order. If this one fills, there is a commission to be paid again. That would increase the cost to exit. But let's send this order off. All right, so that's another potential exit strategy. That's if the thing is going well. If the stock is going up, maybe we let it expire. If it's cooperating, if it's going up, getting closer to expiration, maybe we can buy out inexpensively. Or what if the stock starts to collapse? It starts to go down into the spread. It starts to go down into max loss territory. In that circumstance, maybe the trader decides to pay what it takes to get out, and it might be more than 50 cents. Now, if we're dealing with good liquid options, there should be a good chance that we're able to get out. This is another. Now, you might think, what do you mean, Cameron, a good chance? Well, sometimes if the options are illiquid, you might have to pay up to get an order filled on these things. So that's why it's so important with options traders. The liquidity of the option is a big deal. Trading options on stocks that trade millions and millions and millions of shares can help with that liquidity. In any case, if the stock starts to fall down, in this case, it might be if it breaks down below that price ceiling that we thought might be a new price floor, especially as we get closer to expiration. Maybe the trader considers buying out of some or all of those positions, even if it costs $1, even if it costs $1.50. It shouldn't cost more than $2 because that's the maximum theoretical loss on this trade. Okay, but guys, with that though, we've actually placed our entry, we placed our exit. We've actually accomplished all that we set out to do today. When I kicked things off, we wanted to talk about what short put verticals are, why some traders might take those positions. We've talked through the basics of short put verticals, how much they can make, how much they can lose, assignment risk considerations. We've discussed potential entry signals, trade management techniques, and exit signals. And we've even placed our example trades. So we now have quite a few strategies that we might choose from. Long calls, long puts, short calls, short puts, long call spreads, short call spreads, long put spreads, short put spreads. So many choices. How does a trader pick just one? That's what we're talking about next week. Lesson 10 is going to be about choosing a specific strategy based on one's outlook for the markets, and also based on one's risk appetite. That's another important element. So make sure that you're here for lesson 10. Again, if you didn't catch the first 8 lessons, those are found. Let me just show you where to find those. Those are on our Trader Talk Schwab Coaching Webcast channel on YouTube. So if you haven't subscribed to our channel yet, go down and click on the subscribe button down below the video. But our channel is where we host these playlists of previous webcasts. You can join the live streams here. Just to revisit where we found this playlist, you click on playlists, scroll all the way down, and look for Barb over here on the right. There's Getting Started with Options. Barb, because she taught this webcast series last year. If I click on View Full Playlist right there are lessons 1 through 8. How about I do this for those that are in the live stream audience? I also have the link here. Let me just copy this link and give it to you in the chat window. There you go. All right. But guys, I will see you in lesson 10. If you haven't followed Connie and me on X yet, and if you have an X account, please do that. Follow your favorite presenters on X. It's the best place to connect with them in between the live streams. It's also where you can get sort of more current insights into market developments, things like that. So yeah, follow us on X. You can find Connie there at Connie Hill CS. You can follow me on X at Cameron May CS. And thank you to everybody that's already clicked the like button. I can see 132 people watching right now. 48 people have already clicked the like button. If you appreciate the efforts of your presenter, if you've enjoyed a webcast, make sure that you always click that like button. It only takes a second. Everything that I've just proposed, none of it costs anything. Subscribing, following, liking, but it's all, I think, assists with your learning experience. It helps when you like a webcast. It also gives that webcast a boost in the YouTube algorithm and lets more people find these lessons and learn from them. So that's definitely appreciated. Everybody, I'll look for you in a future webcast. I'll also look for you on X. But until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.